Hello, everyone. As Adele said, I'm Michael Harms, owner and director of Medical and General. We're independent financial advisors. I've been giving advice now to medics for, as Adele said, for over around 12 years. Really what I'm looking to do in this presentation is just give you a bit of an overview as to how the schemes work in the first instance, because then we can contextualize the changes and hopefully it'll make a bit more sense. And I think it's always good just to recap on the schemes. We'll touch on the McLeod judgment as well, what that means for you all, and hopefully just give you a bit of a better understanding of the recent changes and what it means for you. So just before we get cracking, I've just got to walk through this disclaimer. Just shows that we're regulated by the Financial Conduct Authority, and ultimately the content of this presentation doesn't constitute advice in any way, shape or form, but is purely here for information purposes. And a little bit I've already said about us. We basically give advice, financial planning, including wealth management, cover protection, inheritance tax planning. We've then got Medic Mortgages that deals with mortgages, and then M&G Investments Direct, and this is sort of for people who don't want the full wealth planning service but want to get started with investing. So that's enough about us. Let's get cracking with the presentation. So first things first, what is the NHS pension? Well, there are 3 schemes that you can be a member of. You can be a member of 1, 2, or possibly all 3, depending on the career trajectory that you've been through. And let's talk about the actual main differences between the schemes. So the main differences really are the normal retirement ages. Age 60 if you have money in the 95 scheme, age 65 if you have any accrual in the 2008 scheme, and then anything in the 2015 scheme going forward is linked to the state retirement age, which is currently 67. Now, there's something here called the accrual rate. This is the calculation, really, the formula that fundamentally calculates the pension that you will receive at the other end. And we'll talk a little bit more about the total uprated earnings pots in a moment. But this bottom one here, the 2015 scheme, is literally taking your earnings as they stand, dividing them by 54, and that is the level of pension that you gained in that one particular year. Now, with the pension schemes, there are some other additional benefits that come with it. And the main ones here are sort of lump sums. You hear about tax-free cash, your pension commencement lump sums, other various ways of describing it. But ultimately, the main difference is here, the 1995 scheme, which is the old scheme, you will receive a standard tax-free lump sum of 3 times the annual pension that you gained. However, in the 2008 and the 2015 scheme, you actually have to exchange some of the annual income in order to get some tax-free cash. Other benefits that come along with these schemes: ill health retirement pensions, adult pensions, children pensions, and death in service benefit. So the first one here, ill health retirement pension, that's obviously if you can no longer work for a number of reasons. And then the other 3 are all related to your unfortunate untimely passing. So what is ill health retirement pension? Well, this graph here hopefully just gives you a bit of an idea of how that works. So we've taken an example here of a GP earning around 85,000 a year. Hopefully that sort of increases as time goes on towards your retirement age, and then at retirement obviously that would drop down to the amount of pension that you gained, and then that would be index linked from that point forward. Now what we've got here then is this green line is effectively depicting your pension accrual over those years as you get closer and closer to retirement. But if unfortunately at some point during your career you suffer a long-term ill health, then you might be eligible for a tier 1 or a tier 2 pension. Now a tier 1 pension is effectively how much pension you've accrued to that point in time, and how you can qualify for a tier 1 pension is if you can no longer work as a GP. You can no longer continue in your current occupation. A tier 2 pension is a higher definition, and this is where they could give you on the 2015 scheme up to half of your remaining service and pension contributions if you qualify. And a tier 2 pension is if you cannot work in any capacity. So you can't do any role in any way, shape or form. So pretty severely disabled or in ill health at these particular points for a tier 2 pension to come in. So this just shows you how tier 1 and tier 2 works across the different schemes. Ultimately, these first 2 schemes are no longer relevant because everyone is on the 2015 scheme. So tier 1 you would receive on these 2 schemes here if you went off long-term sick, and then a tier 2 would then actually be based on your 2015 benefits. Dependents pensions. So in the event of your unfortunate death, then there are dependent pensions that come with the various schemes. And again, clearly here, you'd all be on the 2015 scheme. So effectively, your spouse or civil partner would receive 33.75% of the notional tier 2 ill health retirement pension, or 33.75% after retirement if you're actually in payment at the time. And then children, as long as they're under age 23, would share in a dependence pension as well, 16.875% up to a total maximum of 33.75%. Lump sum on death. So there's a death in service benefit, and really it's pretty much the same way of working. It's 2 times the relevant earnings. So it's basically 2 times your gross earnings in the last 12 months of pensionable service, or 2 times the revalued pensionable earnings for the scheme year up to 10 years earlier. They're ultimately looking to give you the highest amount that you possibly can, and we'll take a balanced approach on that basis. So how does the 95-2008 scheme work? Ultimately, these 2 schemes work very similarly compared to the 2015 scheme, which is a slight change in how they calculate it. So the 95 scheme, ultimately, I like to consider the pension scheme for you here as a pot, and think about your income and your pension accrual as pouring liquid into that jar. So you're sort of building up what's called your dynamised pot, your dynamised earnings. And so what you put in here are what your actual pensionable earnings every year, say £100,000. And then the idea of the scheme is that it increases by inflation every year. And that's obviously to maintain its sort of real terms value in today's money. And then they add this compounding effect called a dynamisation factor of 1.5%. So sort of all of these things combining, you can just imagine the liquid levels increasing year on year on year, because every year inflation is applied, every year the dynamisation factor is applied of 1.5%. So you really start to see this pot value grow over the course of time. And one of the common misconceptions that we have is that your uprated earnings get confused with what we used to call the lifetime allowance. And it's quite often we can come across people that might have total uprated earnings of 3.5 million. And the reason this confuses people is because it's on the total reward statement and it says total GP earnings. And as I said, quite often clients will come to us to say, well, I'm well above what was the lifetime allowance. And that used to cause a fair amount of anxiety. So just to dispel that sort of myth, basically, this is just a figure of all of your earnings over the entire career to date, increased for inflation, and obviously the 1.5% put in each year as well. And actually what you do is you take that uprated earning value in the 95 section and multiply it by that revaluation factor we showed at the very beginning, which was 1.4%. So in that scenario, if you had a pot worth 3.5 million, multiply it by 1.4%, and that would give you an annual pension guaranteed of around £49,000 per year. On the 95 section, I mentioned that also comes with a standard lump sum. And so in this scenario, you take that 49,000, multiply it by 3, and that means that without having to do anything, you would receive £147,000 tax-free cash. It's slightly different for the 2008 scheme, and obviously different for the 2015 scheme, which I'll come on to in just a moment. But here I just thought it'd be useful to show you the total reward statement, just an excerpt from one that we had. And it just shows you here practitioner earnings 2.2 million. So obviously the example before was around 3.5 million, but just to show you here 2.2, and that clearly is well above what used to be the lifetime allowance, and that's what was causing confusion and sort of, in some circumstances, anxiety around charges and what that meant for you. So let's move on swiftly to the 2015 scheme. It's called a CARE scheme, Career Average Revalued Earnings Scheme. And technically what they do is they take your earnings for that year and they divide it by 54. So it's a 1/54th scheme. And what they will then do is take that slice of pension that you gained and increase it each year by inflation plus the 1.5%. So it's easy to put this in a sort of a table form where you can see up here your pensionable earnings, maybe 97, could be 107,000. And then, divide that by 54. And in this particular year, you gained an extra £1,900 of guaranteed income for the rest of your career. And then what we find is that is then increased each year by inflation plus the 1.5. And so that 1,900 after a few years becomes 2,279. So if you can just think of it as slices of pension that you're gaining every single year that you work. And then at the bottom, we've just got a tally here showing the accrual rates as you go along. So hopefully that explains the differences between the two schemes and how they operate. Now, what I wanted to move on to is the changes to the NHS pension scheme, but also the impact of the last budget. There's been a huge amount of activity in the pension space over the last 6 to 12 months. A lot of it driven by the sort of punitive measures that have come through over the last 10 years and the impacts that we've seen on people's pensions, annual allowance tax charges, concern around breaching lifetime allowance, whether you should use scheme paid, what does the McLeod judgment mean, all of these different things. And ultimately, what I'm trying to do here is just explain what it means, how it's worked, and how that might impact you going forward. So it's firstly probably quite right to say that the NHS pension changes, you've probably all received a letter recently from NHS Shared Business Services, is showing you that the scheme is actually becoming more and more flexible than ever before. And that's about retention. Really, they've seen obviously huge wave of people looking to either retire early, maybe even reduce their working sessions in order to try and skirt around potential tax charges. And ultimately, they've completely flexibly changed the pension scheme to try and make it far more accommodating for the modern retired route. And then the budget changes, this is a wider impact. This has impacted obviously the rest of the country, but I'll hone in on just how it impacts you directly and the positive change that it brings. So, changes to the NHS pension scheme, what's happened? Well, the first thing to say is that employees who've taken their NHS pension benefits from the 1995 section pre-April weren't able to continue or join the 2015 scheme. So that's the first thing they've changed. So they've said, yeah, you can take your 1995 section benefits, and then you can carry on contributing to the 2015 scheme. What used to happen is that you'd have to take either of them together at the same time, or you'd have to become a deferred member of the 2015 scheme whilst taking your 95 scheme benefits. They've also allowed you now to take parts of your pension from the 95 section, some or all of it, basically, over 2 tranches, and still continue to work in the NHS. There's been the removal of what was called the 16-hour rule. This was a rule around, you know, how much time you could work just after taking your pension benefits. And then obviously annual allowance calculations will also be amended to exclude pension growth by rapidly rising inflation. This is the change in when they revalue your pot. So we'll come on to that in a moment. So first things first, GPs who have taken their 95 2008 scheme benefits can rejoin the 2015 scheme. Absolutely, you can. So this is what I was just highlighting a moment ago. Your only option really was to take all the benefits together, which means that you could be suffering quite a huge reduction on your 2015 scheme benefits, because remember, your 95 scheme, you could draw at 60, and the 2015 scheme, you wouldn't be able to take until 67. So that means that were you to take them both at the same time, you'd be seeing a reduction of around 30 to 35% on your 2015 pension that you'd accrued, because you're taking it 7 years early. And the general rule of thumb is if you think it's around a 4% reduction for every year early that you go, then you'll sort of be in the right sort of ballpark. Or the alternative is actually you took your 95 benefits, but then you became a deferred member of the 2015 scheme. And all that meant then is that what you'd gained in the 2015 scheme just increased by inflation every year. So it maintained its buying power, but the real bit that you were looking for was to see an improvement in the reductions. So, you might take that pension, say, 65 rather than 67, but certainly wouldn't necessarily take it at 60. So this has been a really positive, a big positive change for you. So another one that's really, really interesting is that now you can actually take your 1995 scheme benefits flexibly. What I mean by that is that you can take between 20 and 80% of your pension, and you can take it over 2 tranches. We'll come on to that here. So from age 55, which is the minimum pension age, you can take between 20 and 100% of the 95 scheme in 1 or 2 drawdown payments without leaving your current role. You will no longer need to take a break, and you can continue to work in the NHS, but you will need to reduce your NHS commitments by 10%. Currently, you can only draw down up to 80% of your 2008 to 2015 scheme benefits, but actually what they're doing is they're equalising that across the board. So really what this means is as you approach retirement, you have the ability to sort of maybe take a staged retirement approach rather than an all or nothing approach, which we've sort of seen happen over the last 5 or 10 years. So this really does mean that you can sort of say, well, maybe I'll go from 8 sessions down to 4, or I'll go from 6 to 3. And actually, I'll then sort of boost the income needs from taking one of these pensions. But actually, you can still continue to contribute to a pension scheme as well. And I think this has been a really good move because it allows the ability to try and retain you for a little bit longer and make your transition into retirement far, far easier, rather than just one day you say, right, that's it. I'm finished and I'm fully retired. The 16-hour rule. So this was the rule where in your first month, you were not able to work more than 16 hours per week. So this caused an issue if you're 6, well, literally you'd have covered this within a day's worth of work. And so obviously they now scrapped that rule during COVID. And that is something that has now been permanently removed from April this year. Now, what we used to see is a lot of GPs would maybe take a month sabbatical to just avoid that rule, or take a couple of weeks and then obviously go back to work normally. But as I said, that's no longer needed, which I think is a really good positive step. What I wanted to move on to then, the annual allowance calculations being amended. So you may or may not have heard, but there was quite a lot of noise around, well, this particular year, because inflation has been so high, that there could be some exponentially high annual allowance input figures, and therefore some tax charges that are coming through purely because of the way the scheme rules work. So outside of your control, because inflation is significantly higher. So they're now going to move that revaluation date. So what basically happens is every year you've got your pot, and we'll come on to this in a moment, and the inflation would normally be applied on the 1st of April. And all they've done is move that forward, or rather push it back to the 6th of the month. So the pension input period, as it's called, the pension year runs from the 6th of April to the 5th of April. That's in line with the tax year. But we need to understand the value of your pension in each scheme at the beginning of the year, which is the 6th of April, and then at the end of the year. Now, what they used to do was apply this revaluation factor, which was inflation, on the 1st of April. So it fell in the same year. What they've done now is move that to the beginning of the next year. And the reason that's important is because they used different inflation rates at different times. Now, what I've got here is just an example of how they calculate the annual allowance figures. So effectively what they do is they look at what's called an opening value. So they tot up all of your pension at the beginning of the year and say, what was that annual pension that you'd accrued? So I'll come on to an example in a minute. They multiply that by 16, they add inflation, and they add the lump sum. And then they say, well, where are we at the end of the year? And the end of the year is where your pot has then had all of these inflationary added figures, plus what you've earned that year. And then they work that out by taking the annual pension and multiplying it by 16 plus the lump sum on the 95 section. And the difference between the two is the growth. So let's actually put some figures to this. So I've got an example here. We've got a GP earning £120,000 per year. Pension accrued up until April 2022 was £25,000 a year. Well, that means you'd automatically get a standard lump sum of £75,000. Now, the way the scheme works is that they create your opening position on the 6th of April based on the inflation rate in the previous September. So your opening position in April 2022, so the 6th of April, they took your pension value and then they added inflation at 3.1%, which was the inflation rate in September 21. And then they roll that through and they get your closing position. And the closing position is based on then the sort of the revalued figure at the end. So in this example, we've used the 10% increase in inflation for that year, and we've worked out here that you'd have a closing position of 581,000. So you can see here fundamentally there's a difference of around 91,000, and that is called your pension input amount. That is above what was the annual allowance figures of £40,000. So let's just move on and we'll look at, well, what was the concern around that high inflation? Well, it's because, as I said here, the opening figure of your pension is based on the previous year's inflation 3.1, but the closing figure is based on the increased value the revaluation pot, which uses inflation in that year. So we think it's going to be around 11.5% in total. So that means that the growth in the pension scheme would have been skewed based on the types of rates of inflation they use and when they're applied. So if you remember the pot analogy we had, we started at the beginning of the year and now we're looking at the end figures here. So we've had a year's worth of earnings of 120,000. They've applied inflation at 10% to that pot, plus the 1.5% factor, and that has had an impact on your revalued earnings. So at the moment, it was worth around 1.84 million. And in this scenario, we add inflation, add the dynamisation factor, and that gets us up to 2.186 million. We then take that pot, hypothetical pot of 2.186 million, multiply it by 1.4%, and that gives us a pension of £30,612. Now, if you remember at the very beginning, we had an opening figure of around £25,000. So when you multiply those out, the difference between the two is 91,000. So going forward, how will that change? Well, what they've basically done is push forward the inflation or the revaluation date into the next tax year. So it effectively means that the inflation figures being used are exactly the same. So instead of using last year's at the beginning and then actual figure in inflation for the year of growth, they're now doing it that it's exactly the same inflation growth. So what it means is that actually the pension input amount now is only the growth above inflation that you've seen within your pension scheme. So in this scenario here, again, we've just looked at the 1.841 million added in your earnings for the year. And then instead of multiplying it by the 11.5%, actually, we're only looking at sort of 3.1 there. And then ultimately, we've got a closing figure here of, your pension's gone from 25 to 28. And then that therefore means that the difference is only 48,000 in that example. Now, some people might pick up, well, hang on a minute, that means the pension is less than it would have been because the pension was showing us 30,000 on the previous slide. All that's going to happen is that will catch up. It just means we've delayed the impact of the inflationary increase in your pension pot value by a year. But ultimately, you're not missing out. It just means that you're no longer going to get hit as high for the tax charge. Because previously, we were looking at around a £90,000 pension input rather than a £48,000 pension input here. So it's been a really positive step change for you all by making that slight tweak in when those figures get applied. Now, budget changes. What does it actually mean for you? Well, headlines really are annual allowance has increased to £60,000. So the annual allowance is how much money you can put into a pension scheme each year before you potentially suffer an annual allowance tax charge. Now that's changed over time, and I'll come on to those values in a moment. We then also have something called the lifetime allowance, or rather we did have something called the lifetime allowance. And that's been completely abolished under the current government and current legislation. And then we've also got tax-free cash. Now, there's always been a lot of noise around, well, are they going to, abolish tax-free cash? Are they going to take that away? Well, actually, what they've done is they've drawn a line in the sand and said that we're not prepared to allow anyone to have more than X amount. And I'll show that in a moment. And then something that may or may not be relevant to you, it all depends on your personal circumstances. There's something called the money purchase annual allowance. That's how much you can sort of put back into a pension scheme if you've accessed any private pensions flexibly. So that probably doesn't apply for most of you, but there could be a few people on here that do have some private pensions that they may access in the future. So annual allowance, what is it? As I said, it's the amount you can put into a pension each year. Now, pre-2012, it was £255,000. So we didn't see anyone breaching these allowances ever. They subsequently brought that down to £50,000 between 2012 and 2014. There was then this skewed year between 2015 and 16 where they effectively doubled up the amount you could contribute. And that was because they wanted to bring everyone's pension input year in alignment with the tax year. 2014 all the way through to 2023, we had a 40,000 limit. And then from 2023 onwards, they've increased that to £60,000. So if you think back to that example I gave you a moment ago, had you had a contribution of £90,000 in a year, you clearly would have been well above the 40,000 limit. And you would be thinking you need to either pay a tax charge or look back for the previous 3 years to see if you had any unused allowances. Now, once they've tweaked the changes on the NHS pension as to how they revalue your pension pots, you can see that that come down to around £48,000 worth of growth. Now, in this scenario, if your new annual allowance was 60,000, clearly you can see that you would be below the annual allowance and there would therefore be no tax charge. So really good positive steps forward to hopefully remove the anxiety that is provoked by these continual rolling issues around tax charges linked to your earnings that can spike, through COVID vaccinations or whatever it might be, that can sort of have an unintended consequence and impact on your pension. Whereas now, hopefully, most of these issues will have abated as a result of the changes. For all of those that have never seen an annual allowance statement, this is just an example of what you might get back through from NHS pensions. When we send off now authority letters to get information on behalf of GPs, we actually get this back in an Excel spreadsheet in a relatively quick time. So they have improved things dramatically. You used to have to wait around 3 months to get these. And what I would say is you don't automatically get one unless you were above the annual allowance in any 1 year. So it's always worthwhile getting to October, if you've not received one of these, contacting NHS pensions and asking for a copy of your annual allowance figures, just to make sure that you haven't breached any of these annual allowance levels. What I'd like to now do is move on to talk a bit about the lifetime allowance. So let's have a look at that. What is the lifetime allowance? Well, I'll break it into pre-budget and post-budget. The lifetime allowance is the maximum amount of pension that you could accrue in a pension without incurring taxation. And just a couple of months ago, that limit was £1.073 million. And that meant that anything in this area here was not subject to a lifetime allowance tax charge. And therefore, the maximum tax-free cash you could take was 25% of 1.073 million, which happens to be just over £268,000. Anything then above the lifetime allowance would have been subject to a tax charge at 25% if you took that bit above as an income, or 55% if you decided to take it as a lump sum. So pretty hideous on that front. But it was always still worthwhile pushing through the lifetime allowance barrier because the pension you gained was far greater than the potential tax charge. But what's happened now? Well, basically, that tax charge is gone. You still can have a maximum of £268,000 tax-free cash. And that is a line in the sand that they're not proposing on changing. But this bit above here is no longer subject to a potential 25% tax charge on the income, which is what most people would do. They wouldn't necessarily take the tax-free, the lump sum and have taken the 55% tax here. So let's just have a little look at what that actually means physically on these figures here. So if you had a pot value worth 1.435 million when you retired, you'd have an annual pension here of £53,000 a year, with a maximum lump sum of, say, 268,000. Post-budget, the lump sum hasn't changed because remember we've said that's the maximum you can get, but actually you're no longer paying the lifetime allowance tax charge. And that tax charge would be akin to around about £4,500. So it's a significant uplift for those retiring. There are a number of your colleagues who would have retired in the last 5 years, maybe even 7 years, that have been impacted by this quite significantly. But going forward from this year, under current circumstances, it's a fast improvement for all of you. Just going to move on then to the McLeod judgment, and just want to talk a little bit about what the rationale behind it was and what it actually means. Well, this came about because of the phasing of moving you all across into the 2015 scheme. And it was all about your age as of January 2012 and whether you fell within this phasing period, which basically meant if you were closer to 50 in 2012, you would have stayed in the 1995 scheme longer. And if you were below 46 in 2012, you moved into the new scheme 2015 in 2015. Now, that transition period was actually declared unlawful as it was age discrimination, and that was brought by the firefighters. But once the precedent had been set by the firefighters, that was applied across all public sector schemes. Now, what that's basically done is put sort of all of the public sector schemes into a bit of a spin, because they're now not sure quite how they're going to deal with all of these things. But ultimately, there's what's called a remedy period, and that's from 2015 through to 2022. And what they've basically said is, right, everyone during that period will now have their accrual of benefits that were in the 2015 scheme, if you moved at that point, put back in to the 1995 section or the 2008 section. So what that basically means is you now have more pension accrued in the older schemes, 1995 or 2008, depending on which one you were enrolled on. But that does mean, though, there is then a definite line in sand. So from April last year, everyone, doesn't matter how old you were, moved into the 2015 pension scheme. Now, when you come to retirement, and that's the only time you really need to be concerned about this, you will have the ability to choose whether you want to maintain the last 7 years of the remedy period in the 95 scheme, or whether you'd actually like to be on the 2015 scheme. What they will also be doing is revaluing all of your pension growth over the last 7 years. So the annual allowance figures I was talking about earlier, that will all be completely revalued based on the rules of the 95 scheme or the 2008 scheme. So you can imagine that the NHS Pension Agency is going through a huge project here to effectively unwind the last 7 years of pension changes. And so we are told that these changes will come into effect from October this year. We're still waiting really for full clarification as to how the remedy will be implemented, but our understanding is that everyone will effectively be given up-to-date annual allowance figures based on your contributions being put back into the old scheme. And then from April last year, you will be on the new scheme 2015, and the only time you need to make a decision around which scheme you want to be on for that 7-year period will be closer to retirement. Assumptions that you shouldn't make. Whilst this ruling means that you don't have to move into the 2015 scheme until April this year, you shouldn't assume that this will be in your best interest. In the vast majority of cases, it probably would, but it does depend on your own personal career path and your earnings, because that would determine sort of how much pension you've accrued under each scheme. It also depends on sort of your retirement plans as much as anything else. The annual allowance charges might go up by moving back into the 95 scheme. Equally, they may go down. There is literally no one size that fits all. And the reason I say that you shouldn't make the assumption that going back in the old scheme is better is because the accrual rate on the new scheme is better, it's higher than the old scheme, but there are trade-offs. It doesn't come with a standard lump sum, and obviously you'd have to take it a little bit later, potentially than the 1995 section. So it all comes down to your personal circumstances, the type of retirement you want, and really the impact of those annual allowance charges going forward. That sort of brings me to the end of that presentation. Does anyone have any questions at all?
Yes, we've got some questions. Right, let's go. They're in the chat, so I don't know whether you can see the chat.
Let me just bring that up. Okay, I took a pension in 2012. Is that the one?
Well, yeah, so further up, if you go from the top, it says that how does the NHS pension changes affect GPs who have retired but are still working?
Basically, if you've retired and drawn your benefits, you can now go back into the pension scheme if you wish. That was something that you weren't able to do.
Right. Continue paying into it.
Yeah, you can actually rejoin the 2015 scheme and
Right,
continue to pay into the pension scheme.
Okay. Do we have to pay tax on the pension when we take it out? If so, how much?
It depends on your personal circumstances. So you don't pay tax on the tax-free cash element. That's the lump sum you can take. The income, the annual income, would just be treated as normal income coming into your household and therefore subject to normal income tax.
Normal basic rate or higher rate tax?
Basic or higher rate, yeah, absolutely.
If you are 60, is it advisable to take the 95 pension now and carry on working? Or does it not matter if you plan to retire at 63 and take the whole pension then?
So, age 60 is the normal retirement age of the 1995 section. If you do not draw on that pension, it is still growing, by inflation plus the dynamisation factor of 1.5%, but you are giving up on that income for every year. So what used to happen is you weren't able to sort of carry on in the pension scheme. But now on the basis that you can continue contributing to the 2015 scheme, even if you draw the pension, it's probably a good idea to think about taking that pension at 60. Because otherwise, I'll give you an example. Say you've not taken your pension, 95 section pension was up to say £45,000 a year. And for every year you didn't take it, it increased by, on a normal year, 5%. So by a couple of £1,000s. So next year it might be worth 47,000. Well, yes, that's gone up by £2,000, but you've just given up on £45,000 of income for a year. And you've got to kind of ask yourself the question, how many years have you then got to live having deferred drawing that pension every year to get back that extra £2,000?
Okay.
So in most cases, it makes sense to take it at the normal retirement age.
Okay. I joined the partnership last year. My practice told me that I'm not contributing in my pension. I work mainly in the NHS mainly in hospitals since 2006, and I was on the 2008 scheme. What should I do?
So you've joined the practice and they've said you're not in the pension scheme.
So presumably you should contribute to the pension scheme.
Absolutely. Yeah, you need to be contributing. And hopefully, as the partnership, your accountants will be able to help you ensure that you are submitting correctly to do that.
Does my contribution to a SIP count towards a total 60k allowance?
Yes, it does. So this is the fundamental difference. Physical contributions into a private pension, so in this case, a SIP, which is a self-invested personal pension, that is the physical bit that goes towards the £60,000. And then, as I've shown you with the formulaic approach with your NHS pension, that growth goes on top. So you combine those two growth figures, the figure you have on the annual allowance document that I showed you an example of, plus what you've physically paid into the SIP.
Okay. If my annual income is below the 60,000, can I still contribute up to 60,000 towards my pension, both the private?
Okay, so privately, no, you can only go up to 100% of your gross earnings. So if you earn, say, £40,000, you could only physically contribute into a personal pension £40,000 gross. However, your growth could be bigger than your earnings through the NHS pension, depending on the circumstances and how the formula works out.
Can you explain the taxation of the lump sum, please?
Okay, so your first £268,000 would be tax-free. And that's all there is to it. You wouldn't want to take any more tax-free cash. So it's limited by the lifetime allowance, £268,000. Anything above that, you would be taxed at your normal income tax rate going forward.
Okay, next question. I've taken a firmly head in the sand approach to pension so far. I've been in and out of the GP scheme and in a CCG scheme. What do I need to ask for? Who do I need to ask for NHS pensions advice? Well, you've got Michael.
What I would say is there's some homework to do to start. So the first thing you would want to do is ensure that you have a full up-to-date employment record. So go to PCSE, find out from them what your employment history is, what your contributions are. And what you would get is what's called a dynamisation sheet or an employment sheet as well. So if you get a dynamisation sheet, that tells you all of your earnings as a GP. And what it will have is a job code down the side. Now, those job codes are important because that would determine whether you earn money as a locum, whether you earn money as a salaried GP, or whether it was a partnership or any other, various job that you'd taken on. So the first thing to do is to get an up-to-date document. Once you have the employment history ID, I would always make sure that you get your annual allowance figures as well. The annual allowance figures are important because they are official figures and data that goes to HMRC. And a specialist financial advisor can work those figures back to tell you what your pension is worth. But you want to make sure that your records are correct first, because if your records are incorrect, your annual allowance figures are incorrect, which also means then the projection that you can get on what's called the total reward statement would also be incorrect. The final bit would be to get the total reward statement. This gives you a flavour. It's probably the best way of putting it. It is not a very good document in terms of giving you an accurate pension figure. It gives you a flavour based on data that could be 3-4 years out of date. The other thing to be aware of as GPs is that you're submitting your data, and sometimes as a GP partner, that could be 18 months after the year has ended. based on where your accounts land and when they get submitted. The other issue is you're at the mercy of Capita and then actually getting your pension data and then submitting that to NHS Pensions for an update. So it's good housekeeping, I would say, to start off by asking for an employment update in terms of the list, getting your annual allowance figures. And if your annual allowance figures are not updated for the last 3 or 4 years, that would be suggesting to me that your contributions haven't been submitted officially or correctly to PCSE, or they have been submitted, but maybe they haven't acted upon them. And so you need to raise a complaint to go through that process. Once you've got yourself up to speed, then actually it's just an annual thing you need to do by contacting them every sort of October, making sure you get your up-to-date figures and ensuring that everything looks as it should be. But it's far easier to do it whilst you're in a position that you've got all the data to hand and it's fresh in your mind. If you leave it another 10 years and then you retire, the chances of you trying to recollect and get the information to prove that you've made these contributions will be harder.
Thank you. I've got a question from a GP locum. I work as a locum GP via a limited company. What's the best way for me to start securing a pension? Don't want to miss out on pension benefits as a result of working via a limited company. If paying into a pension whilst working by a limited company lowers overall tax, then of course I don't mind doing that and having less income in a limited account.
Yeah, this is the difficulty. Obviously, being a locum in a limited company means you can't really contribute into the NHS pension scheme. Your best option then is if you've decided that the NHS pension isn't the best option for you, then you can make director pension contributions into a personal pension. What that would mean is you would save on corporation tax, which is due to be sort of 19% for people earning below 250,000, and you would save on dividend tax as well. And that money would go into a private pension that you could then draw upon, currently from sort of 55 or 57 onwards. But what I would say is you are giving up on a substantial benefit with being within the NHS pension scheme. It really does require you to have a good conversation with a financial advisor to sort of plan this out and understand what's more important for you. Because whilst you might be earning more today through the limited company, what you're potentially giving up on is guaranteed income at retirement. And you just need to be able to be sure that that is absolutely the right method and the right route for you.
Thank you. The 90/95 scheme, I believe, is last 3 years' salary. Is that the average of the last 3 years or the best of the last 3 years?
No, okay, so you're getting slightly confused with the hospital doctor method, which is a final salary scheme. So consultants and junior doctors in a hospital setting will be using that method because it's based on your final salary. The way your service works is it takes whatever you earn every single year and then takes a percentage, or it takes 1/54th, depending on which scheme you're on. So you are on a career average earning. So you're already on the way the new scheme is working. What's changed for consultants and hospital doctors is they've now moved away from that final salary scheme and they've moved into a similar scheme that you've been operating on for the last 23 years.
Because I know consultants, when they were getting towards the end of their career, used to increase the amount of sessions they were doing the NHS.
So yeah, basically the game was that you would probably try and get some CEA awards, maybe some silver or bronze awards as well towards the latter part of your career in your last few years, which basically means you've not had to pay all the contributions in those early years. You might have to pay an increase in those last years, and then ultimately you boost your pension quite significantly in those last few years. That sort of ability to do that has completely gone. And now everyone, as I said, on the 2015 scheme, there is no difference now between your scheme and your hospital doctor counterparts.
Right, okay. If you've previously engaged in scheme pays, would there be some sort of reimbursement with the changes to the lifetime allowance?
Hope so. Yeah. If it depends whether you've taken it or not. If you've taken your pension, no. I think the understanding is that has gone. That's happened, and there's a line in the sand. You can still continue to contribute. You won't be subject to any lifetime allowance charges. Annual allowance tax charges for scheme pays, if you're still an active member, when they move this back in, the remedy, the McLeod judgment, and they look back at those 7 years and put you back into the 95 section or the 2008 section, there's going to be a complete rehash of those annual allowance pension input figures, which basically means then you may be owed money if you've physically paid the inland revenue. You may owe a little bit, depending on how those figures work out. or if it's scheme pays, the NHS Pension Agency will have to affect all those changes on the scheme pay election forms. So as you can imagine, this is a huge, huge undertaking, which is why I think they're struggling at the moment to sort of get that information across.
Okay. If I joined the NHS in 2001, was I in the 95 pension scheme?
Yes.
Right, you were. Okay.
Unless you moved into the 2008.
Right.
They did an exercise in 2007-8 and so it was pension changes, and they sent a document out and said, if you want to change, you need to let us know. If you didn't do anything, then you remained in the 1995 section.
Okay. If you have different jobs, GP part-time and employed, for example, by the ICB, is pension automatically collected in one pot? We hear the PCSC is years behind. And also, what happens if somebody started in Scotland and moved to England?
Okay, right. So there's a number of questions in that. The first one is different job roles. This is why the employment history is important, because you should have contributions being put in under one employment ID for your ICB role, and then you should also have your GP earnings going in under a different ID. Now, the best thing to do is if you're employed through the ICB is look at your payslip, and hopefully that will indicate that you do have contributions going in. And again, depending on whether you're salaried or partnered or locum, will determine whether you have a payslip or not. And you can check that those contributions are being made. But the ultimate test is to go to PCSE and see whether they have those contributions listed. And if not, then you've hopefully got the proof with your payslips and everything else, and you can chase up those contributions and make sure they get updated. In terms of your second question about Scotland, they are effectively two different schemes. They're administered differently. You've obviously got one in Scotland, one in the UK, in England. Depending on how long you were there, you probably would want to transfer from Scotland across to England, and vice versa if you felt that that's where your long-term career would be. Otherwise, you can keep them running as two separate schemes, but ultimately you'll come to a point where you decide you move into one or the other.
Okay. We've got loads of questions, but I think we should probably end it there. That's okay, everybody. Sorry about that. There were loads of questions, too many to get through in this session. We'll send you a copy of the slides, and on the slides you'll find Michael's details. So I've been working with Michael for the last year. Fantastic person to work with, honest, trustworthy, and I would recommend him if you want any further advice regarding pensions. Okay.
Thanks, Adam.
So thank you everybody for attending. You'll all get a copy of the slides. You should also receive a certificate of attendance as well. Okay. If you want to register for our further meetings, our next one's on renal medicine, please go to our website. So hope to see you again soon. Thank you very much, everybody. Bye-bye.